I think one of the things that's really striking about the condition right now is the equity market has been extremely diverged, if you will, from the Treasury market. Treasury seem to be looking at 2020 with, half the GDP that the equity market is right now. And I think that divergence is a little bit what you're seeing on the screen right now, where bond yields are starting to climb, rise up 10 years up to 216. And equities are bid, once again. And so I think the question that's in the back of everyone's mind over the last few weeks is which market is more right, the bond market or the equity market?
Can they both be right? Can they both be wrong?
I would say that both of them were a little bit wrong, actually. I think treasuries were overbid. Is the economy and the projected economy really that different from September and October when bond yields were going to 3.25?
No, but if I'm a sovereign wealth fund in Norway, I'm just making that up, and I'm looking at a negative yield on German debt, why would I buy that? I'm going to go buy U.S. treasuries.
Well, that's one of the dimensions of the whole treasury story, right? And why it's not necessarily an indication that we are going to be that depressed next year, right? Look, 120 basis point move in the 10 years in 7 months is enormous. But what's been happening on the Bund side is extremely relevant because Bund yields, when crashing lower, right? You had Brexit, you had lower growth in Europe, you had this continuing problems in Italy, right? All the usual deflationary buy Bunds rationales. And as that accelerated, the correlation of Bund yields with Treasury yields accelerated a lot. So in a way, the Treasury market seems to be saying, hey, maybe the case is for the U.S., we're going to get a lot more rest.
The market, at least from my little perch here, seems to be acting erratically. And that, I wonder if that should make us nervous. We go up, up, up. In December, we tank. Then we go up, 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 up. And then in May, we go down. Now we're going up, up, up. Right. We're moving in these weird cycles now, which I don't know if it's ETFs or index funds that are sort of skewing the norm. But it doesn't, there's a smell test.
Well, I think it's sort of the nature of how volatility is expressed. Look, every bull market through time, you need bloodletting, you need some volatility. But what we see is these extremely sharp sort of V-shaped corrections where out of the blue, the market can get smacked, or a key index can be smacked 4%, 7%, 8%. And rather than consolidating, bouncing around, and confusing people for a few weeks, it sort of V's right back and confuses people even more. And I think that's a little bit, as you said, we just saw that in May, right? This vicious V. The question is this broader risk-on rally since December, you kind of want to feel a little bit like it has a more comfortable floor that's a little bit more stress tested, where it goes down a little bit more.